Hello and welcome to this Davis Rea quarterly conference call. Thank you very much for being with us. I'm Mark Bunting, the publisher and host of Uncommon Sense Investor, sponsored by Davis Rea. We have some poll questions for you again today. We'll sprinkle those throughout the show. They're all yes or no answers, and all you have to do is enter your answer in the chat box on your screen. We always love to know what you're thinking. So those poll questions will start shortly, and then we'll have some real-time results for you in just a while. The agenda today a little bit different than usual. It's just John and I. I'll be introducing John O'Connell in just a moment. We have a lot of interesting topics lined up for you. We'll look back to 22, one last look at 22. We'll look ahead to 23. We're also going to spend a lot of time on innovation and innovation themes and trends, and what does that mean for your portfolio? What kinds of sectors and stocks do you need to be in? What sort of sectors and types of companies do you want to be out of? So we'll be delving into that. John's done a lot of reading on AI, augmented reality, and these kinds of things are coming fast, and so we'll be talking a lot about innovation. Enough about me, enough blather. Off the top, let's introduce John. Chairman, CEO, CIO, Davis Rea Limited. How are you, sir?
I'm very well, thanks, Mark. Why the colorful shirt?
You know why, John?
Tell me.
There are brighter times ahead. Brighter days ahead, everybody. That's why.
We certainly hope so.
Yeah.
We certainly hope so.
Well, the markets are looking good right now. Who's to know how long it will last, and we'll get into that in just a second. But as I said, let's take one last look back at 22. And this question comes from a client, and I'm paraphrasing, but what are some of your top regrets, if there are any, mistakes and or errors in 22, and what can you do differently in this year and beyond to sort of make sure they don't happen again, or do you have a different take on things?
You know, I thought about this question quite a bit, and I don't really have any regrets, and I don't think we made any mistakes. We stuck to our discipline. You know, we don't take price as a signal of what value is. Price is an arbitrary number that gets thrown at you on a day-to-day basis. Value, which is what we try to do when we invest in companies, we value companies, and we actually think about what they will be worth down the road. That's what investing is about. Looking at price is speculating. You know, at the end of 2021, you know, portfolios were up 28% or so, a very strong performance. 2020 was very strong performance as well. And at the end of 21, we said we wouldn't be surprised if 22 were a difficult year. You know, it was a difficult year, and it was a difficult year for everything. You know, war, inflation. You know, the S&P 500, which is the biggest 500 companies in America, were down around 20%. A lot of big companies, and some that we own, were down 30-40% or more in some cases. If you were investing in the fixed income market, you were down 12%. It was a tough place to invest last year. And I think, you know, it's important for investors to remember that these things happen on a fairly regular basis, and the reason why you are investing and the reason why you invest in value and why you think about investing in companies is because you want to be able to think about what the future brings, not what the past or the present is bringing you. It's not about the present, it's about the future. That's what investing is all about.
And your equity fund, while down, did beat your benchmarks, essentially. Is there anything you would change, anything you do differently that you would bring forward into what you're doing now?
You know, once again, I don't think so. You know, if I had perfect foresight, I would have sold everything and sat in cash. We would have paid some taxes. We probably would have been a little bit better off in the end. But, you know, if you listen to all the hugely successful investors, Warren Buffett, Howard Marks, they have a tough time picking tops of things. They have a better feel for the bottoms. And my sense is, you know, in June, when investor pessimism was very deep, we thought we're close, but maybe a little bit too early. October, we felt very strongly that we were very close. Maybe we didn't pull the trigger as aggressively in putting some of our cash to work as we could have. But, you know, we're still invested in the market. The thing I find irritating about market strategists and whatnot is to say, oh, you know, you got to be in cash these days. Well, that's just not practical. People have investments. You can't be all in or you can't be all out. So, you know, I feel pretty good about the way we behaved. For the most part, most of the companies that we did continued to build towards the future and build their businesses stronger and stronger, and I don't think anything's changed.
Okay, time for our first poll question here. Very simple, yes or no answer. Will there be a recession in Canada and the United States this year? Will there be a recession in Canada and the United States in 2023? Just enter your answer in the chat box. We'll have some results in just a moment. So speaking of 23, here we are with a fair-sized rally to start the year, but then again, you could argue a lot of it's the crap, pardon my language, that didn't do well last year that people are running up. And so just more broadly from a macro picture, do you still think that we're looking at decelerating growth globally? We're looking at inflation having peaked, decelerating in inflation, but now we're into the portion of the profit recession of the bear market, and the question becomes, when does that end? When do times seem to be starting getting better? And then that's the time to put serious money to work.
Yeah, that's been the narrative for about a year and a half now. All through 2022, people were calling for a recession. They said the first half of 22 we were in a recession. Then they pushed out to the second half of 2022. And everybody was talking about inflation and how high the Federal Reserve Board was going to raise interest rates. The last quarter, the fourth quarter of 22, was the strongest quarter of the year. And we talked incessantly about inflation and how much the interest rates were going to go up. And, you know, now we're pushing the recession out to the second half of 23. And the big dialogue right now is how much are profits going to go down in 23. So let's start worrying about 23. And it defies expectations to keep pushing things out and worrying incessantly about what's going to happen this quarter. We're having earnings being reported right now for the last quarter of 22, and for the most part, they've been pretty good, which makes sense because the economy's actually been accelerating. Now, there's no question that interest rates have been raised a lot, and there's going to likely cause some deceleration. But we're also hearing Federal Reserve Board officials saying, yes, we're closer to the end. We're getting close to the end of raising interest rates. And there's no question that we're seeing inflation moderating. And as fast as it came up, it might just go down as fast as it went up. So my sense is that businesses, and particularly the businesses that we own, have made and are taking the right steps to protect themselves for the future. And you know, there's people that are worried about things. Will Microsoft report good earnings tonight? Is the cloud growth going to only be 27% versus 30%? It doesn't matter. I mean, the advent of cloud is going to happen. I'm sure all of our listeners have heard about OpenAI, ChatGPT. All these things are going to continue to push. These innovations are going to continue to push increased usage of computing power. And Microsoft, Google, Amazon, other companies in your portfolio, Apple, these companies are at the cutting edge of this. We have to stop worrying about the traffic accidents that are being reported to you on a daily basis.
We have our results from our first poll question. Will there be a recession this year? 82% say yes, 17% say no. So we're looking at, supposedly, according to our viewers at the moment, at least a couple of quarters of recession, shallow, deep, who's to know. But based on your...
go ahead. Just, you know, that we have a recession, all the indicators are saying that we're likely going to have a recession. What's made this so confusing and difficult to predict is that, at least in the States where we do most of our investing, the U.S. consumer has a job. It's hard to find people to do work. There's huge savings in investors' accounts, higher than they were in 2019. So it's very difficult to see a recession when so many people have work. We're seeing a drop in fuel costs, which is a big predictor of consumer confidence. We're seeing people out shopping. Some cases that's causing high prices, but we're seeing people have bought all the refrigerators in their cars and all the stuff that they had to buy during the pandemic when they couldn't go out. So they're out, you know, enjoying things. Avatar, a Disney movie. about to cross $2 billion, all-time $2 billion in sales. People are shopping. So all this talk about recessions like the world's going to stop. In 2020, the world stopped. And the stock market ended up 12%. So, you get thrown off by all these people that are talking about these big, complicated solutions, and you lose track of the fact that you got to invest money. And you have to own things. If people yelled outside your house every day, the price of your house, I'll buy it for $1 million, I'll buy it for 800,000. Would you pay attention to that? No. So this talk of a recession doesn't mean that everything goes down and that's the end of the world. What happens when the recession ends? Let's say it's 6 months from now. Well, the stock market looks at least 6 months in the future. At least. And if you're smart, you're thinking 2 years in the future. So when we're finally in the recession, now what are we going to worry about? Missing the rally.
Yeah. And just last question on this topic, on this area. Based on your experience, are you concerned about a credit event? I'm thinking of, say, Blackstone Real Estate Fund. They're freezing assets and redemptions, or at least redemptions. Same thing with KKR. Are those canaries in the coal mine? Are you worried about something like that, or a Fed policy mistake where it's just not rational in the markets and things overshoot and there's some sort of an event, something happens?
Yes and no. I'm not worried about a credit event in the big scale of things. Businesses are in good shape. Consumers are in good shape, at least in the States, not so much in Canada. What I do worry about, you mentioned the Blackstone real estate thing, that was selling an illiquid investment to retail investors. And they thought that they had liquidity, and they don't. I worry a great deal about when interest rates were low, everybody was trying to look for a place to earn their money. And a lot of investors, a lot of people were sold special purpose, private credit funds. A lot of that's been done in Canada. There are a number that have blown up in Canada, bridging finance. Romspin's has gated and they're not allowing redemptions. I worry that there are more canaries in the coal mine there. But that's because unscrupulous people have sold illiquid or inappropriate investments to individual investors.
Right. That Blackstone fund used to be quite exclusive and you needed a lot of money. I think you needed to be a accredited investor to invest in it. And now it's they're kind of letting moms and pops in, and so we'll leave that
whenever
there.
you say, "Oh, we're going to give you something that you can't normally get, trust us, we're going to get it for you," be careful.
Mm-hmm. Okay, next poll question: have the markets bottomed? Have the markets bottomed? John was alluding to that just a little while ago. And when we say markets, we're talking about the major indices. Naturally, the S&P 500, Dow Industrials, NASDAQ, TSX. So that's our next question. Answer yes or no, please, in the chat box. We'll get results on that. All right, so more broadly in how you approach investing and how you do your research, you've talked before on camera with us about how many hours a day you do reading. And I'll listen to the investment committee call and go, how the hell does he know that? Like, how does he know all this about AI? So yeah, you do a lot of reading. You have a lot of different sources, the Bloombergs, the RBC, the TD, independent research, Yardeni, and so on. But when you add it all up, how do you distill all of that to one unifying system and thesis as to what does that mean for me and my clients and how do I invest?
Well, first, I'm not alone. We have a team of people that work together. And they all work very hard. And we have an exciting announcement to make tomorrow about a new addition to our team. This business is the greatest job in the world. You're able to learn and read and watch what successful investors do. And what successful companies do. There is a plethora of information available. Technology's brought that information to anyone's touch point if they wish to. I believe in the mosaic approach to investing, keeping it simple, just investing in big, dominant, innovative companies that have incredibly powerful products or services with strong management teams. They tend to have strong balance sheets and cash flow statements. And keeping an eye on how industry and business is evolving, how it evolves based on technological innovation. I don't get too bogged down in politics because in the end, business navigates around politics. I don't get too worried about the global situation. I pay attention to it. I appreciate that it's cyclical in nature. I think you just need to, just read a lot, be thoughtful, but in the first case, keep it simple and focus on what is really a powerful, dominant company, and then just avoid the news and relax and let them work for you. The value of these things go up and down on a daily basis. That's the price that we spoke about before. But what you really care about is value. As Warren Buffett said, price is what you pay, value is what you get. And if you keep it that simple and think about where is the value, it's not that hard to see. Peter Lynch said, look at what you use every day. You use these kind of things. Mm-hmm. 5 years ago, people said nobody used these things. And now it's a $41 billion business.
The AirPods.
Yeah, people are saying all kinds of things about the new things that are being developed that will be the huge things in 5 years. So you want to keep your eye on the future, not get thrown away from the present.
All right, you use the word mosaic, so let's apply that to financial markets, and more specifically, the stock market. Would you say that, yes, obviously it's a very complex organism, and there's so many moving parts, so many things happening from a macroeconomic perspective right down to earnings, to every little data point possible. And it looks chaotic. But would you say that there is some order within the disorder in that all those pieces in some way or another fit together? And they do kind of make some sense. Would you agree with that?
Yeah, 100%. Think of the analogy of this room. It's full of all kinds of molecules that are moving around at incredible rates and all kinds of stuff. But if you sort of step back and look at it, it looks quite calm. So I think, going back to what I just said, you need to be paying attention to the chaos that's taking place, but not pay too much attention to it. Are there storm clouds on the horizon? Is it going to blow? Yes, it's going to. We're always going to have storms. Are the things that you invest in fundamentally, that value proposition that I've spoke about earlier, can these companies withstand this? Are they paying attention to it? Are they investing in the future to make sure that they can deal with that chaos? But I think if you try to look at every data point and pay too much attention to it, you're getting sucked into what Bay Street and Wall Street wants you to be paying attention to, which is the day-to-day chaos that they sell and talk about, because if they can get you concerned about the chaotic opportunities out there, you will engage with them, and by engaging with them, you'll pay them, and that's what they want. And that's not necessarily in your best interest.
All right, John, we have an update on our, I believe it's our first question, which is the first poll question. Is there, will there be a recession this year? It's now 66, wait, no, actually, you know what? I'm wrong about that. Hold on, let me correct myself. Have the markets bottomed? 64% say no. 35% of our viewers currently say yes, they have bottomed. So
that's really interesting, because that's what the consensus is out there. And it once again, that goes into the chaos. Markets are chaos. There's thousands and thousands of companies out there that are running around, and people say, has it bottomed? Well, Meta bottomed at $90 3 months ago. Today it's $145. So, getting caught up in that chaotic market atmosphere is you run the risk of being wrong. And it's interesting because if you're investing for the long term, the chaos today doesn't matter. But if you're investing for the long term, or if you're worrying about the chaos today, you run a big risk of missing things. And in 2008, 2009, I was working at RBC, and that was chaos because the financial system was cracking. And in 2020, in April, May, that was chaos because the world economy was shut down, and we were all huddled in our rooms hoping we weren't going to die. Investor sentiment in October, November of this year was worse than both those periods of time. At a point when people were working, unemployment was at record lows, and people were so pessimistic and the stock market fell by 20% or 30%. People are looking at price. They're not paying attention to value. I don't know whether the market's at bottomed. Nobody knows. But I do know that there's a lot of companies that are making a great deal of progress about the future.
All right, you mentioned Meta, and this leads nicely to our next poll question. Would you be comfortable with we're going to use 20% as a guidepost, but are you comfortable if your favorite stock in the next year or so drops by 20%? Are you comfortable holding it if you still like it? So are you comfortable with that, yes or no? So having said that, what about Meta? Because last year, it was down, I want to say 66, 70%.
Yeah.
But as you've said, it bottomed a while ago for the time being and has had a big run up since then. So anybody who panicked and said, I want out, I want nothing to do with it, they've missed. I mean, it's still well down for where it was. But what's the philosophy there in terms of buying and holding, continuing to hold, even though you're struggling and suffering, and so are your clients, but if you still believe in the company's fundamentals and overall outlook? Sure.
It's a really good example. First, if I'd known that it was going to fall to 90, I would have sold it. And when it went from 270 to 220, if I'd known it was going to go to 280, I would have sold it. And when it went to 140, I would have sold it. The company announced earnings that were pretty much right on spot with what people thought, and the stock fell 25%, 2 quarters in a row, in a second. No reading of financial statements. That was just an instantaneous drop, a vacuum, so to speak. Investors take on narratives, and these narratives are propagated through people like us, through the media, the newspapers, and the investment community, which responds to price. And some people, the price drives them to distraction and crazy, and the stock falls. And the more it falls, the more inclined people are to sell, which is kind of bizarre when you think if a company is generating a great deal of profits and revenues, which Meta was, it's one of the most profitable companies in the world, but because it's falling, people look for excuses and reasons why is it falling. And so in the case of Meta, they were making enormous investments in artificial intelligence and machine learning and virtual reality and augmented reality. The same investments that Microsoft's making and Apple's making and Google's making. But in the case of Facebook, there was this added concern about their advertising business. But mostly it was about them making investments in the future. And it took on this case, and it can afford to make those investments. I mean, the company reported revenues of $110 billion. It would have been up more if it hadn't been for a very strong US dollar. And they allocated about $10 billion of their revenues to investing in virtual reality and artificial intelligence,
right,
and optical reality. They can afford to do it, but people didn't get why they were doing it. And I go back to the case of the iPod earbuds. Steve Jobs said a long time ago, design products that your customers don't even know what they want yet. There's a great deal of interest, we're going to talk about it later on, about OpenAI, ChatGPT. The same technologies that was doing is the same technologies and innovation that Meta's looking at. So we looked at what the company was spending and what it was earning and said, nothing's changed. The profitability hasn't changed. So if I'm going to get blown off course by what other people are deciding to do with the arbitrary nature of the way they price something on a day-to-day basis and sell it, then I'm lost. Where do I buy it back? Or do I respond based on what other people value something at, or do I respond based on the fundamental value of what this company is generating? I may not like the guy, but that's not really the point. I'm investing in, does this company generate, for every $1 of revenue, they generate 80 cents worth of gross profit. After paying taxes and spending money on all kinds of things, including protecting their existing franchise, where they spent most of their money trying to adapt to the technological problems that were being introduced to them from privacy concerns and constraints and regulation. Even after all of that, they still dropped 30 cents of pure, unadulterated profit to the bottom line. There's so few companies that do that. And at $90, the stock was trading at about 8 times earnings. It's crazy.
Okay, let's get to some poll results here. We asked you whether you're comfortable if your favorite stock fell by about 20%. Would you hold on? And 72% are saying yes, we would. So let's move along to, so you didn't sell Meta, but you did sell, for example, within the last year or so, FedEx, Stryker. So clearly the fundamentals changed in one way or the other. The stories changed, the narrative changed. Using those as examples, how do you know when to sell? How do you know when to pull the trigger and say, you know what, this is not working anymore?
When the fundamentals change. So first, we sold FedEx. We didn't sell Stryker. We sold Stanley Black & Decker.
Sorry, yeah. You still own Stryker.
Yep. FedEx, you know, the long-term theme was global trade, just-in-time delivery. FedEx had a long history of growth and sophistication in terms of its logistics business. They had a big market in Asia. They made an acquisition in Europe called DHL Express. That transaction was difficult. We stuck with it for a couple of years. They just never seemed to really be able to integrate that acquisition, and they continued to stumble. And we put it on the watch list. We were concerned about it, and you know, we finally came to the conclusion: we own Amazon, and they own this huge logistics business. We don't need to make this more complicated. And we lost confidence that the management team could turn around the business and get it properly integrated, so we sold it. Stanley Black & Decker had a long history of integrating acquisitions, aggregating the do-it-yourself professional tool business, innovative in the way they did things. The wheels started coming off during the pandemic, and they just were not able to get a hold of their supply chain problems. We lost confidence. The CEO left the firm and retired, and we just said, we don't understand what the problem is. Something's happening. Milwaukee Tools seems to be getting a lot more innovative and gaining market share. So the fundamentals changed, and so we had to sell it. It was really disappointing.
Let's get into the innovation part of our conversation, themes and trends, and where you're thinking about investing and what you're thinking about. And then after you hear John talk for a while, we'll have a poll question in and around that area. So you sent out a Bloomberg story yesterday about Apple. They're working on these glasses where eventually you'll have these glasses on, you'll use your eyes to isolate an app, you'll be able to pinch it, and using sort of, it's basically an iPhone now in your glasses. You can pinch the app and open it and give it commands. So that all sounds well and good, and we know that there are gamers using very advanced augmented reality glasses and goggles these days. But I guess my question is, where are we at with this kind of innovation? And yes, we saw the cell phone go from a brick to what we have now, and home computers go from big clunky things to very slim laptops.
They're in the cloud.
And in the cloud. So where are we now in terms of these types of innovations with these glasses, and the potential that we won't need laptops anymore? We won't need screens. Is it 5 years away? Is it 10 years away? When do we see Marge in Iowa walking around going like this, walking down the street using her glasses?
This took 5 years to be a $41 billion business. I think that we're on the cutting edge of a whole new revolution in technological disruption. If you look at what's happened behind the scenes, the reason why we've been, you know, what we really do with our reading, Google has been investing in artificial intelligence and has been the leader in artificial intelligence for years. They bought a company for $600 million in 2015 called DeepMind. That was all about machine learning and artificial intelligence. Facebook bought Oculus in 2015. for $1 billion. Microsoft was developing the HoloLens and making artificial intelligence investments. Tim Cook was saying 3 years ago that they felt that augmented reality was a big thing. It was a big coming thing, which was why when we looked at Facebook when they were making these investments, it wasn't really about Facebook making these investments. People don't like Mark Zuckerberg, and they love Tim Cook. I think that we're on the cutting edge, and we've now got to the point where computers are actually writing the code that designs more code. And it's not going to put everybody out of work, but it's making it faster. And you look at artificial intelligence will develop as quickly as two things happen. It's how fast your computer chip is and how much electricity does it use. Those are going to be the two limiting factors to the development and the advancement of this. And my sense is that the advancements in optical technologies, so that right now we see big, huge goggles. In 5 years, they won't quite be this small, but they'll be something around this. That is going to change a lot of industries. It's going to affect the healthcare industry through natural language processing, where doctors won't have to take notes anymore. They'll be able to dictate them, and they'll be stored in electronic records, no longer paper records. It's going to affect the robotics industry. It's going to affect the banking industry in terms of processing millions of transactions and not having to have people checking them all. It's going to affect the way we work. It's going to have profound impacts. Think about it this way. Microsoft did a joint venture with Facebook 3 months ago. Today, Microsoft just said they're going to stop funding their virtual reality goggles business. 3 months ago, the CEO of Microsoft said, we're going to work with Meta and we're going to work with Apple as well, because this is going to be a big thing. Eventually, you will not need, I think within 5 years, you won't need to have a screen in front of your desk. You will not have a keyboard. You'll be able to control it through your ears and through hearing with these kinds of apparatuses or something else. You'll be able to see it on your glasses, and you'll be able to manipulate it whatever you want with your fingers. That's going to have profound impacts on how much office space you need to use. It's going to have a profound impact on how much electricity we consume to power these large screens, which is going to be an amazing thing. How much hydrocarbons we have to use to make keyboards and screens. How much energy is consumed in making those kinds of things. I mean, the applications are enormous, and I think that we're at the cutting edge of it. And why I'm a big believer in the companies that we still own they're the ones that are investing the most amount of money. They've been at this for a long, long time. This is not new. This OpenAI ChatGPT thing is not a new thing. And it's been around for a long time. And what's so interesting about these big companies that you own is that they have millions, if not billions, of customers. So the incumbents.
Right. And you're talking about Google, Microsoft, Amazon primarily.
And Apple.
The big ones. And Apple, of course, yeah.
They have all these customers that they can drop these technologies into. Microsoft will be dropping artificial intelligence into your word processor. I mean, right now, as you type, it's solving for words, and it's getting, all of a sudden, it used to be like correct spell check, and now it was one word, and now it's whole sentences.
Yeah.
You can actually reply now on emails and says, thanks, that's great to know. So there are privacy concerns, for sure, but eventually a lot of that intimate knowledge of you married with artificial intelligence will be actually natively held on your device. And so I think there are going to be big shifts. I think it's going to be very exciting, and I think there very well may be some new entrants, but